Working capital. It's one of those terms that shows up in every finance conversation, and one a lot of people use without being able to define cleanly. This video fixes that. We'll cover what working capital actually is, why the concept exists at all, the two ways it's measured, and the part most explanations skip, why having more of it isn't better, and why manufacturers carry more of it than almost any other kind of business. We'll use Redline, a real reconciled manufacturer, for the numbers, but the ideas apply to anyone who buys, builds, and sells. Let's get into it. Start with the problem working capital solves. In a manufacturer, cash goes out before it comes back. You buy steel and aluminum, you pay people to machine and assemble it, and you pay for all of that weeks, sometimes months, before a single customer pays you. That lag between spending cash on production and collecting cash from sales is the gap working capital fills. Working capital is simply the money a business keeps tied up in day-to-day operations to bridge that gap. It isn't profit, and it isn't a one-time cost. It's cash that lives permanently inside the operating cycle, funding the business between paying for inputs and getting paid for outputs. That operating cycle is worth seeing as a loop. Cash becomes raw material becomes work in process on the production floor, that becomes finished goods sitting in the warehouse. Finished goods get sold, usually on credit, which turns them into a receivable, and the receivable eventually turns back into cash. Every step in that loop ties up money. The longer the loop takes to complete, the more cash a business has to keep parked in it just to operate. Working capital is the fuel in that loop, and the size of the loop is what decides how much fuel you need. So how do we measure it? There are two definitions, and both are right. They just answer different questions. The accountant's version is net working capital, current assets minus current liabilities. On Redline's balance sheet, that's about $34 million. It's a broad liquidity measure. Everything short-term the company owns against everything short-term it owes. The operator's version narrows it to the three accounts that actually move with production: receivables plus inventory minus payables. For Redline, that's about $49.5 million tied up in the operating cycle specifically. Use net working capital when you're asking, is this company liquid? Use the operating version when you're asking, how much cash is the operation itself consuming? This video is about that second question. Here's where intuition usually goes wrong. It's tempting to think more working capital is safer. More cash, more inventory, more cushion. It isn't. Working capital is money that's locked up and not earning anything. Too little and you starve the business. You can't buy materials, you stock out. You can't make payroll. A liquidity crisis. But too much is its own problem. Every dollar sitting in excess inventory or slow-paying receivables is a dollar you borrowed or could have invested doing nothing, and carrying it costs interest, storage, obsolescence, and risk. So there's an optimal zone, enough to run smoothly, not so much that cash sits idle. Where that zone sits depends heavily on the industry, which is exactly why manufacturing is a hard case. Manufacturers structurally carry more working capital than most businesses for three reasons. First, inventory isn't one thing, it's three: raw materials waiting to be used, work in process on the floor, and finished goods waiting to ship. Money is tied up at every stage. A software company has almost none of this. A manufacturer has all of it. Second, the production cycle takes real time, days or weeks from raw material to finished part, and cash is locked up the whole way. Third, and this is the one that stings, manufacturers often have the least power over payment terms. Big distributors and retail chains dictate 75-day terms. Suppliers still want paying in 30. You collect slowly and pay quickly. The worst combination for working capital. Redline carries about $23 million in inventory and $36 million in receivables for exactly these reasons. So what can a business actually do about it? 3 levers, one for each account. Collect receivables faster. That's days sales outstanding. Hold less inventory, or turn it faster. Days inventory outstanding. and pay suppliers slower, days payables outstanding. Pull any of these the right way and you free up cash. But each lever has a limit. Lean too hard on inventory and you stock out and lose sales. Push payment terms too far and suppliers raise prices or cut you off. Chase customers too aggressively and you strain the relationship. Managing working capital isn't about minimizing it. It's about tuning these three levers to the tightest setting the business can sustain without breaking something. Exactly how those days turn into a cash timeline is its own topic, the cash conversion cycle, and that's the next video. Two last ideas to take with you. First, how to read it. Rising working capital isn't automatically bad, and falling isn't automatically good. You have to know why. Climbing because sales are growing is normal. Climbing because receivables aren't getting collected or inventory isn't selling is a warning. Same direction, very different stories. Second, the one that catches people. Growth consumes working capital. A bigger business needs proportionally more receivables and more inventory to run, and that cash goes out before the extra profit comes in. When Redline scaled up, its operating working capital rose from about $37 million to nearly $50, cash the growth demanded up front. That's why fast-growing, profitable companies can still run short of cash. We unpack that timing in the next Foundations video on the cash conversion cycle. And to see it play out as a real decision inside a company, that's playlist 1 of the main series. Every number here ties to the dollar. See you in the next one.